Hi, Mike Verdi here again, Chief Investment Officer at Lighthouse Financial Services. And I'm here with another monthly edition of our Market Update webinar. Without further ado, I'll share my screen here and we'll start. Okay, November 10th, 2022. I'll go over the agenda first, and I guess the reason I wanted to do this update video today was because we've got two important catalysts in capital markets over the course of this week. And the first is inflation, and this is obviously today's big story. The CPI, or the Consumer Price Index, which is a widely watched gauge of retail price inflation, rose 7.7% in October. That sounds terrible. It's pretty high, but it's significantly lower than it was in September at 8.2%, and it also was lower than expected. So we all know that peak inflation came last summer, but the question now is, okay, but then how fast is it falling? Because we really do need to get it down to a manageable level, and depending on who you talk to, if it's the Federal Reserve, it's 2%. Others might say 3%, but we need to be showing some progress there. So good news. In addition, I will say within the report, we found out that housing costs are still kind of high, but they're also coming down 6.9% year over year. And wage growth, in addition, decelerated, and we need to see that. I'll talk about why in a minute or two. Okay, so this CPI report really had a profound impact on capital markets today, on the dollar, on bond market, the stock market, commodities, and so I'll highlight in this presentation a little bit of the effect on interest rates today. The Fed funds rate, which is the policy rate the Federal Reserve is hiking right now. That rate is seen to be rising to about 4.9% by next May. That before today, that was well over 5%. So I think expectations for rate hikes are falling a little bit. And after that, after May, I think economists and investors pretty much agree that rates will begin to fall over the next 2 years. Economic growth, again, the core strength in this economy is inspiring. I'll say just the strength of the job market, the strength of consumer spending, but it has a dark side as well, and that is that it's making it harder on the Fed to do its job. Remember, the Fed is raising interest rates in order to slow down consumer spending, and therefore slow down growth in the economy, and then slow down inflation. And so that's their tool, and it's making it a little bit harder on them, the fact that the economy is pretty resilient. Finally, I'll talk a little bit about midterm elections, and not a whole lot we can say definitely here, but it looks likely that the GOP will take control of the House of Representatives. All right, so let's get into the details. Here's a chart that I show often, and I call it the path of inflation. It's CPI, Consumer Price Index, along with the core CPI. So, and the core just means we're leaving out food and energy. So why would you leave those out? Because those are the big part of the problem, right? You know, that gasoline, anything energy related has been very volatile, and the inflation rate with regard to gasoline has been pretty high. Also, food costs are probably up anywhere from 9 to 11% year to year. Anyway, back to the chart. What you notice is the big spike in 2020 to 2021, and by the midsummer 2022, it's pretty clear with the black line, that's CPI, that we've reached peak inflation, and so it's clearly headed down. And today's report confirmed what we already felt we knew, which was that inflation is coming down. The blue line, however, core, if you leave out food and energy, that's been a little stickier. and the Fed watches that gauge pretty closely. So it was good to see that come down because it had made a new cyclical peak in the prior month in September. So now we see in October that costs did come down. Again, great news. Oh, by the way, let me go back 1 second. What's coming down and what's sticky upward with regard to inflation? So airfare is coming down, apparel, goods, anything manufactured goods are coming down, used cars are coming down, and a big part of inflation in the month of October was housing costs and rents. And we know that rent is coming down, but it's coming down from a pretty high level. You know, Zillow, according to Zillow, the growth rate in rent or inflation rate in rent earlier this year, I think it peaked out at like 17% year over year, and now we're down less than 10%. So it's falling rapidly, but it's still up there, kind of high. Another part of inflation that's been kind of sticky to the upside has been wages, and the Fed has said that they are kind of targeting the job market. They want to see some weakness in the job market because it's just red hot. They say it's imbalanced, and of course, you know, it is true that the supply of available labor it does not meet the demand for labor, right? So they'd like to see the labor market come back into balance, but that means a softer labor market. That means a softer job market. And I just wanted to point out with this chart that the unemployment rate in the blue has ticked up just a tiny bit recently. And more importantly, average hourly earnings, or the inflation rate of wages, right, it is coming down. It's moderating. And so according to this one measure from the Bureau of Labor Statistics, wage growth peaked out in about March and has been headed lower. Now, okay, this is bad news in that we all like wage growth. Wage growth is great because it fuels consumer spending, which is 70% of our economy. Okay, so that's one side of the coin. The other side of the coin, though, is that the Fed feels like a very tight job market and higher than average wage growth is feeding the inflation that we're seeing. So, you know, bad news is good news in that average hourly earnings is coming down. The growth rate is coming down, but that's good news because we're hoping that this gives the Fed a little bit of permission to take a breather and maybe not raise interest rates as high as they had been expecting to raise them. And that's why I did this chart. The Fed funds rate is in orange. This is that policy interest rate. And you can see it moving in a step function upward since March of this year. And the question is not whether they'll raise rates, but how high and how quickly. So this policy rate is already at 4%. The guidance from the Fed plus the bond market already tells us that this rate will likely go to 4.9% within the next 6 months. So we know it's going higher, but what if it doesn't? What if inflation falls at an acceptable rate from here out, and it's pretty clear to the Fed that they're going to achieve their goal of 2% inflation within the next 2 years? It's our view that if the Fed is convinced of that, they may not have to raise to 4.9%. And remember, and I've said this many times, the less we get in terms of rate hikes, the better our chances of avoiding a recession. Yes, we're having a reset in stock valuations. Home price valuations are coming. Bond market valuations have already reset. And there's had been nowhere to hide, but now that we're returning more to normal, the Fed can start thinking about maybe not hiking rates as much as long as inflation cooperates. So because today's report was viewed as cooperation, you get the 2-year Treasury note yield, and that's in blue, falling. You can see the end of that chart. It's come down from its peak. And so in other words, the bond market and the stock market are looking at that CPI report and kind of reading through to what the Fed might, how the Fed might interpret that. And so you got stocks and bonds rising in price today. And one more just side note on this blue line. If you were to have bought a 2-year Treasury note from the government a year ago, you would have locked in roughly a 0.5, 0.6% yield per year for 2 years, just 1 year ago. And now with this reset in valuations, how bonds have sold off and interest rates are rising, now you can book a 4.3% yield for that same 2-year note yield. So a lot of securities, a lot of investments have reset to the point where they're fairly attractive, and that's kind of how we feel about about at least the short-term Treasury market. All right, so I mentioned the stock market. What is the impact? Okay, well, the stock market has been actually rising since mid-October. I know it doesn't feel like that because most of what we're reading and hearing on a daily basis from the financial news media is really terribly negative. And I would say even 24 hours ago, I was talking to my partner, Rob, about the fact that it seems like on Main Street and Wall Street, the consensus is that recession, in other words, the economy contracting and all that's attendant with that, is really a foregone conclusion, that will definitely happen. It's not my view, it's not our view that is a foregone conclusion, however. And the stock market's always looking forward. As I like to say, it's a discounting mechanism. It's always looking forward, looking to extrapolate into the future what it sees today. So market's been rising since mid-October, and today was a massive rally. I think the S&P 500 closed up more than 5%. That's ridiculous, right? But the best rallies do come during bear markets, they say. So we don't know whether this will stick or whether we'll have to go back down and retest that mid-October low. But for now, you can see that it's very simple. If we can get the inflation to cooperate, you get the dollar is going to follow that. It's going to weaken a little bit. Stocks and bonds are going to rally. That's where we are because capital markets have sold off so much this year that you get some good news and it's kind of spring-loaded upward. So the bottom line is, I think the CPI report provided a little bit of light at the end of the tunnel, or at least it corroborated a trend we already thought we saw. And so you got a couple of more dovish Federal Reserve Bank presidents making some comments today. And this quote is from Patrick Harker at the Fed Bank of Philadelphia. The Fed will slow the pace of our rate hikes as we approach a sufficiently restrictive stance. And that's what we want, right? We know that the Fed is going to continue to keep interest rates at a high level for a while, but can they at least slow down those rate hikes so that instead of 0.75% raise each month, maybe it's down to 0.5% or 0.25%, or maybe, as I said before, instead of going from 4% to 4.9, maybe they go to 4.5 and call it good, and they step back and wait and monitor what happens to the economy. And the reason that's important is that there is a well-known lag between the policy decision of raising interest rates, or they have other tools too. Basically, the policy decision to tighten financial conditions in the economy. There's a lag between that and the impact to the labor market, the impact to consumer spending, the impact to businesses. So that lag is roughly a year. And so it's good that the Fed recognizes there is a lag and that they understand that they need to step back and wait. A lot of wood has been chopped this year. In other words, the financial conditions have been tightened very, very quickly and by a lot. And you can see that. I go back to this time and time again because it's so intuitive. You can see that in mortgage rates. Started the year around 3, and as of yesterday, what was it, 7% plus? So that is that's a big change in a very short period of time. It's our view that the Fed probably should pretty quickly step back and let this new higher level of rates filter through the economy. I should say something in closing about the midterm elections, although, as I said before, there's not a whole lot that's clear. Perhaps the thing that's most clear is that things didn't change that much. And so I think there's a little bit of everything, depending on which side you're on. The Democrats have said that they avoided the red wave, and it's likely they did. On the other side, the Republicans are likely taking control of the House of Representatives. And so, I think the most likely outcome of this is going to be just sort of more gridlock, which is incidentally exactly what investors want to see. I think investors don't want politicians fighting yesterday's battles. The last thing we need to do right now is another major spending package that isn't paid for by tax revenue. Because, by the way, that's how we got into this whole mess with inflation, was just massive increase in government spending, money that we didn't have, and that we know leads to inflation. So back to this slide at hand. We still have 3 Senate seats up in the air, 3 races that are undecided, and it looks like one likely could go GOP, the other one Democrat, and Georgia will have a runoff in December. So, and by the way, does that sound familiar? Right, same thing. So we'll have to wait for that. And then in the House, we still have somewhere between 30 and 35 uncalled races there. And a few of those are in California. We have 2 Democrats running against one another, so it doesn't change the balance of power. But of the other 30 races, I think the Democrats need to win something like 27 out of 30 in order to keep control. So that's why we say that it's likely the GOP has gained control of the House. But as I say, I don't expect any major balance of power change. It's just the gridlock that could be a good thing. Here are our disclosures once again. I want to thank you for watching, and we'll be back next month, or maybe with a special update if something important happens. Bye-bye now.